and welcome to Business Line. This time we focus on the foreign currency loans in Europe. It's been a month since the Swiss National Bank entered a policy meant to limit the franc's value against the euro. And the consequences have gone way beyond Swiss chocolate and watches getting dearer. When the franc almost instantly rocked up 20% against the euro and even more against the currencies of Eastern Europe, hundreds of thousands of homeowners found themselves unable to meet their monthly mortgage payments in francs. The Swiss National Bank estimates that loans totaling 220 billion francs are currently outstanding in Eastern Europe. In Poland, around 550,000 mortgages are denominated in Swiss francs, 150,000 loans are affected in Romania, 60,000 in Croatia. We don't have Hungary on the list, although the Hungarians were among the region's most enthusiastic borrowers of francs.
Hungary's government has been widely criticised for its unorthodox economic policies, but its decisions on Swiss franc loans are being praised. People like this man, Laszlo Szilágyi, had to take a job in Britain to earn enough to repay his mortgage in francs. He and others were saved when the government passed laws pushing the risk from currency and interest rate fluctuations back onto the banks. But more than €1.5 billion worth of car loans were not covered. So Marty Gerhardt has seen his loan leap from the equivalent of €8,000 to 14,000. He complains the risks were not explained to borrowers. He says, I'm thinking that it would perhaps be worth my while to go to court because there are so many court cases going on now that are similar to my situation, where nobody told us about the possible consequences. Other countries are now looking at the actions of controversial Prime Minister Viktor Orban, asking how they can fix the exchange rate for conversion of euro and Swiss franc mortgages into their local currencies at below market levels. But a government spokesman says it's not that simple. Some neighbouring countries are interested, like Croatia, Romania and to an extent Poland. But you have to know that the Hungarian model didn't just happen overnight. It was created in a long process, more than 3 years, when we were able to address this complex problem in a proper atmosphere and framework. Hungary was also lucky with timing, completing its mortgage conversion program before the Swiss central bank scrapped its cap on the currency, which sent the franc soaring. This business journalist we spoke to says the Hungarian model could work, but you need a lot of luck. I don't think that it could be copied in other countries with similar problems because the legal and the economic situation is very different in those countries. And I have to add that this was an excessively risky step which finally turned out to be a lucky one. And only for a lucky few, as before the Hungarian government changed the rules, many families and companies had gone bankrupt in recent years as they couldn't repay their foreign currency mortgages or loans.
Hungary's embrace of the franc was the most extreme in the region, so the government's decision to change it, and particularly its timing, has been highly praised. We're joined now by Euronews business correspondent in Budapest, Beatrix Asboth. Bea, can we say these measures are clearly positive, or it's not so black and white?
Well, it's definitely not so black and white. The regulation is positive, we can say that. But it's a very complex situation and the Hungarian government was very lucky. When the government introduced the regulation converting FX loans, the exchange rate was around the market level, higher than back at the time when people actually borrowed the money. Now debtors see this whole regulation very positive because the installments they pay monthly can decrease by 20 or 30%. Banks are not so happy. Earlier they had a good deal, a good profit on the constantly changing exchanging rates. But the Hungarian National Bank supports the banks with €9 billion for converting FX loans to forints.
There was Euronews business correspondent in Budapest, Beatrix Asboth. Thank you very much.
Thank you.
The other Eastern European countries are yet to find a solution to this problem, as the foreign currency loans, not necessarily in francs, are quite popular in the region. Euronews correspondent Maria Korenyuk joins us from Kyiv. Maria, what's the situation in Ukraine?
People took to the streets and held rallies in front of the National Bank of Ukraine, but the only solution the National Bank could offer them was a special memorandum. But to enact this memorandum, the Ukrainian parliament will need to make amendments to the Internal Revenue Code of Ukraine, so much will depend on the will of the MPs.
There was Euronews Kyiv correspondent Maria Korenyuk. Maria, thank you very much. We'll have more on the economic problems in Ukraine in our next story.
Conflict in the Ukraine property market. Many owners signed up for dollar mortgages, which were popular before 2008, but a falling exchange rate has hit them. 7 years ago, Natalie's apartment was priced at $95,000. She still owes $65,000, but the market is dead and she can't sell to clear her debts. I used to pay $760 each month. Since last summer, even with our family income, which includes my husband's salary, we cannot meet the monthly repayments. 13 banks have signed a proposal by the central bank that the loans could be restructured at the official rate of exchange as of January the 1st last year, with the lender then writing off the difference. Owners who bought an apartment or house within a certain size, and if it is the property where they actually live, will get 50% of the loan written off after the debt restructuring. The others will have 25% written off. In 2008, the rate of exchange dropped from 5 to 10 hryvnias to the dollar and finally settled at around 8. Since January last year, it tumbled further from 8 to the current rate of 26 to the dollar.
We've seen how dangerous it could be to get a loan, especially if it's to buy a home or a car. But you may need a really big one in the future. What for? This is it. This is IT.
Legend has it Apple was born in Steve Jobs' garage. Well, rumor has it someone in that garage is now actually working on a car. A few hundred employees of the California-based company are reportedly researching how to create an electric vehicle. According to the Wall Street Journal, the design of the project, codenamed Titan, resembles a minivan. Of course, provided they decide to go through with this, introducing an actual car will take years. But all the other pieces of the puzzle seem to be in place. Money. When announcing the latest results, Apple revealed it is sitting on a cash hoard of $178 billion. Manpower. Former Ford engineer Steve Zadesky was chosen to run a secret lab, and he's just one among dozens of employees with ties to the automotive industry. Tech. Apple is already developing an operating system for dashboards, CarPlay, and according to Reuters, self-driving capabilities are not to be excluded. And finally, motivation. After breaking the $700 billion market cap record, Apple needs a new long-term goal to show markets there's still room for improvement. That was it. That was IT.
And that was it for now. Thank you for watching, and we'll see you next week.